It would seem that the shutdown is fully over, all the funding bills have been signed, and there are simply no significant negative catalysts right now that would force the markets to fall. Trump is saying that in the next 5 to 6 months, the US economy will start booming. Yet if you look at stocks and crypto, it feels like we're standing on the edge of a new crisis instead. Bitcoin has fallen below $95,000 for the first time since May. And the real reason is one thing only: problems in the US labour market that have crushed the odds of a December Fed rate cut to a 50-50 coin flip. A month ago, those odds were almost 100%. This signals that after the shutdown ended, investors came back to watching economic data and are preparing for the Fed meeting on December 10th. While Trump is motivating everyone with "America will prosper," his son Eric is saying that soon there will be a massive flow of capital and gold into Bitcoin. Yes, it sounds like honey to the ears, but the fact remains, the market is critically short of liquidity, and that liquidity will only appear when the Fed turns the printing press to maximum, which will stimulate the US economy. And part of that money pie will naturally flow into risk assets. That's why the current economic reports will be decisive at least until the end of this year. Friends, I won't argue, the market is falling, and it's not pleasant, but it's also not the worst thing that can happen. I've personally been in the market for over 5 years, 3 of which I've been actively running this channel. My old viewers and I have survived crashes like Terra Luna, record Fed rates, 9% inflation, and of course the historic FTX scam. Every single crypto crisis has ended the same way, with growth. So today let's break down what's coming next, which reports we should watch, how they will affect the market, what will happen to Bitcoin in the coming week, why we're falling at all, and at the end I'll tell you what I'm doing personally during this correction, and how those of you with drawdowns in your portfolios should act. Lately I've noticed that many newbies and even fairly experienced investors are taking losses and can't handle it psychologically, so they lose the emotional game to themselves. I'd like to share my experience and make a separate video on market psychology, where I'll cover all the nuances of emotions in the market and how to control them properly, especially during drawdowns and losses. So if you're interested, hit 1,000 likes and the video will be on the channel, and feel free to ask questions on this topic in the comments right now so I can answer them in the video. $10 for a comment under the previous video goes to this viewer, so write comments and get another $10 for subscribing to the Telegram channel. Now, without further ado, let's begin. Right now, the market is in a phase where skipping fresh metrics and news is absolutely not an option. That's why I recommend you immediately subscribe to my Telegram channel, where my editors and I post the most important market information, exclusive insights, and key metrics. Today, I posted an analysis of Bitcoin's death cross with a price forecast, so go subscribe and find out what impact this pattern will have on Bitcoin. All fresh economic reports will also be in Telegram. So what are the catalysts for the drop? At the start of the week, Bitcoin fixed above 100k and even climbed to 107k, but immediately rolled back as soon as news appeared that the odds of a December rate cut were falling. Expectations for a December cut started dropping for one simple reason. The Fed sees too many risks to ease policy right now. Inflation has slowed, but according to Fed officials, it's still too hot around 3%, above target. In these conditions, any premature rate cut could reignite prices, and that's exactly what the Fed wants to avoid. At the same time, the labour market has slowed, but isn't showing sharp deterioration that would force the Fed to act more aggressively. And because some key data were delayed due to the shutdown, the Fed simply doesn't have a full picture of the economy, so it makes more sense to wait than to risk. Additional pressure comes from signals from Fed officials themselves. Powell has long said a December cut is far from guaranteed, and regional bank presidents emphasized that the bar for easing remains high. The Fed is caught between inflation and the need to support the economy, but today price control is the priority, hence the more cautious policy. For Bitcoin, this is a temporary cooling of expectations. Markets believe that easing, liquidity inflows, and cheap money are being postponed, and those are the main fuel for crypto growth. Let's talk about the labour market in more detail. US companies cut more than 11,000 jobs per week through the end of October. And this is no longer a one-off figure, it's a steady trend reflecting real weakening of the labour market. Yes, the last report said the economy still added 42,000 jobs, but new weekly data paint a much more alarming picture. Hiring is falling and businesses are becoming cautious. For the Fed, this statistic is a key signal. Fed policymakers are literally watching the labour market under a microscope and any weakening increases pressure on the regulator toward future rate cuts. That's exactly what shapes market expectations. The weaker the labour market, the higher the probability that rates will start coming down to prevent further economic cooling. After the record 43-day shutdown, investors were effectively blind. Economic data are coming in delayed, some statistics are distorted, and the market is trying to figure out how deep the damage will be. Some analysts forecast a 2% GDP drop. Others believe most of the damage will be offset by a quick rebound in federal spending. But the key problem is different. During the shutdown, some workers were technically unemployed, and RBC analysts are already warning that employment data may be seriously distorted. Investors will need time to understand what is really happening in the economy and whether stock markets are overvalued in the absence of normal statistics. Only after a full picture appears will it be clear what is really going on in the US economy. But what's happening right now? Investors are hedging. When there is uncertainty in the market, it's easier to sell risky assets and choose something safer like gold, which has been rising this week. That's why stocks and crypto are falling. But the important question, can this really be considered the start of a major bear market? My answer is no, because the facts speak for themselves. Any threats of a US economic slowdown and labour market problems are, on the contrary, a reason for the Fed to cut rates, stimulate markets, and inject liquidity. The only barrier is inflation, for which there is currently no data. But keeping CPI around 3%, which is possible if duties on China are lifted, and cheaper imports increase, should not be an obstacle for the Fed to cut rates. Also, regarding the drop in December cut odds, we should look at the dollar index and bond yields. As we can see, the dollar hasn't really strengthened. It has actually been falling since the beginning of the month, while 10-year yields are flat. In periods when the Fed really didn't cut, both indicators shot up, creating pressure on Bitcoin. This tells us that despite expectations, there is no real capital flight into bonds. And while some liquidity that could have gone into crypto has flowed out of stocks and is hiding in gold, which is rising, this movement will only start after the data are published. Most likely in the 20s, like in October, we'll get the postponed CPI data. On the 19th, we have the FOMC minutes, which will show the real mood of the Fed and readiness for QE starting December 1. And at the end of the month, on the 26th, third quarter GDP data. Then everything will be back to normal schedule in December. But because of the shutdown, the upcoming data will be fuzzy. Investors have reduced risk, that is, investments in stocks and crypto. That's what we're seeing now. Yes, the period in the market is not the most pleasant, and watching red candles for more than a month hits everyone's morale. I'm also not thrilled that the market can't find support and consolidate properly, because liquidity is still sitting in fiat or gold. So right now, friends, we need to wait for the data. But of course there is good news. The current correction allows you to close profitable shorts that not only offset portfolio drawdowns, but even put you in the green despite the red market. And our Coin22 Pro subscription will help you with that. For example, this week we shorted Solana when it broke $150, made money on the drop in Arbitrum when it tested 24-cent support, and on many other trades. And right now, to stay in profit, you need not only to buy the dip, but also to regularly open such trades. Trading lets you make money both on the way up and on the way down, so any market movement works in our favor. I'm a long-term investor myself, but from time to time I actively trade, especially now to hedge drawdowns in my spot portfolios. All Pro members get training, support, and most importantly, 24/7 assistance. Together with my partner exchange BitJet, we'll make your trading simple and profitable. We've been doing this for 3 years, so if you don't know how to offset your portfolio drawdowns and have trouble trading, we'll help you figure everything out. You can get answers to all questions by following the link in the description. But if the market is falling, who is selling right now? The whale topic has resurfaced, whales dumping Bitcoin. The wave of large sales, transfers to exchanges, and profit-taking has really intensified, and this immediately sparked talk that the cycle is ending. But if you look deeper, the picture is completely different. Analysts at Glassnode say the recent selling wave is not panic or a sign of collapse, but perfectly typical behavior of the late stage of a bull cycle. According to their data, large holders are taking profits exactly the same way they did in every previous cycle, and large transfers only illustrate this trend, but do not indicate a mass exit of big players. On the contrary, Glassnode emphasizes that the average daily spending of long-term holders has risen from 12,000 to 26,000 BTC per day. This is even distribution, not the kind of spike that usually accompanies the end of a cycle. In essence, it's normal profit-taking by old holders when the market reaches a mature growth phase. CryptoQuant and other analysts also call what is happening a cyclical flow, not fear. Late cycle does not mean the market has peaked. It means slowing momentum amid macroeconomic pressure, but not its death. As long as there are buyers willing to absorb supply, the cycle can continue. On-chain, we're already seeing the first signs of a potential bottom. The net unrealized profit loss, NUPL, coefficient around 0.4 indicates the formation of strategic entry zones. This suggests the market may be closer to a local low than a final top. At the same time, some analysts note that unlike past periods, buyer strength is now noticeably weaker. Institutions, ETFs, and large funds have temporarily reduced activity due to uncertainty around Fed rates, macroeconomics, and the long shutdown. However, this weakness can disappear as quickly as it appeared as soon as the Fed changes its rhetoric and continues cutting rates. There is also an ongoing debate about Bitcoin's 4-year cycle. The formal October high was reached roughly 550 days after the bottom, the same as in previous cycles, which allows us to assume the top is already in. But the market itself disagrees. The demand structure has changed, and new players, ETFs, corporations, and large investors no longer live within the cycle. Their decisions now depend on liquidity and macroeconomics, not the calendar. The market is not showing signs of a mass exit of old holders, and most data point to a healthy late-stage bull cycle. The real trigger for further movement will not be whale behavior, but macroeconomics, Fed rates, liquidity, and the return of large buyers. Until those factors kick in, the market looks overloaded but unfinished. I also have data for you showing that the current decline doesn't look like 2022 at all. Coinbase data clearly showed how dramatic Bitcoin's price movement has been since the start of the liquidation. Bitcoin first updated a local high at 104K, then crashed almost $8,000 and closed below 97K, just 2% above the keyholder wall around 95K. The market literally went from a comfortable 5% above the wall to almost touching it in a few hours. And this dramatically changed the price dynamics, even though the wall structure itself remained the same. Cost-basis distribution shows that roughly 65% of all investments are above 95K. Almost every short-term holder coin was bought at these levels or higher, and about 30% of long-term holder coins are also in this range. This is not the light bubble structure of 2017 or the early peak of 2021 when speculators dominated. This is a densely saturated zone of a mature market, reminiscent of the second wind at the end of 2021, when experienced participants and newbies ended up in the same range and balanced there for months. That density explains why the spot market barely grew all last year. The pre-election race attracted a huge wave of buyers between 95K and 115K, but instead of growth they ended up in a sideways range with no way out upward. The current short-term holder cost basis is 112K. And every time price fails to reach these levels, more and more new buyers end up underwater. Long-term holders, on the contrary, are calmly distributing across levels slightly below the highs. When futures started unwinding, it became clear how weak new demand was between 106 to 118K and around 100K. ETF flows also weakened. They were no longer enough to absorb forced sales. The key difference of this cycle from the past is who is selling. In 2017 and 2021, pressure near the peak was created mainly by short-term holders fixing speculative profits. Then the market cleared and old coins went into cold storage. This time it's different. Almost half of the recently sold coins are coins of large buyers who entered the market last year and are now capitulating. Glassnode data show that since October, short-term holders have gone into loss relative to their 112K cost basis, and their realized profit ratio has fallen below 0.2. This means more than 80% of the coins short-term holders sent to exchanges were sold at a loss. This is basic capitulation of new buyers, not an exit of the old guard. That's why the 95K level remains important. It was the failure point of the entire bull cycle, and right now Bitcoin price is still above it. New Coinbase data show that a bottom around 95K would drop price deep into the long-term holder zone, where the overwhelming majority of coins remain unmoved. If this group continues to hold, the wall can really absorb forced sales from short-term holders and derivatives. If Bitcoin loses 95K without a buyer reaction, the next support zone is around 85K, the low of the tariff hysteria, where the market already formed a local bottom. Below that lies the real market average around 82k, the final gap zone after the pre-election campaign, which would become a natural magnet for a deeper correction. Only below these levels begins the wide demand range between 50k and 75k that hasn't been tested this cycle. At the same time, the risk profile of this cycle is very different from 2022. Back then, losing the 45k range led to a rapid collapse. Short-term holder cost basis fell to 54k, the support range didn't hold price, and the market almost instantly crashed to the average around 36k, filling a huge multi-year air pocket. Now the distance between the range and the average is a bit smaller, and last year's fundamental demand is much closer to the current price. So a move from 95k to 80k, while painful, doesn't have to turn into a deep multi-year bear trend. Overall, I expect Bitcoin to start forming consolidation in this range and cement a local bottom. Yes, the short-term backdrop remains tense, ETF flows are weakening, buybacks are giving way to outflows, and options are looking downward, indicating growing demand for downside protection. But ultimately, the fate of the market will depend not on futures players or short-term traders, but on the holders who control the majority of supply just above and just below 95k. They are the ones who will decide whether this range becomes a reversal point or whether the market for the first time this cycle breaks below this important level, and everything will be decided by liquidity. The US Treasury is ready to start injecting liquidity in the next 2-3 days. According to JP Morgan estimates, by mid-December the system could receive about $300 billion a mini version of Fed QE. For the market, this means one thing. After months of pause, fresh capital is appearing again, which usually supports growth in risk assets. For Bitcoin, such injections are a strong catalyst. When liquidity expands, demand for crypto grows fastest. So if JP Morgan's forecast is confirmed, December will be when the printing press makes itself felt. But friends, I perfectly understand your mood during this drop. Many of you have portfolio drawdowns right now, and that's absolutely normal. Believe me, I've had such drawdowns dozens of times. Even my experimental portfolio that I assembled after the October crash is now showing $6,000, and what do? I sell nothing. And even if it were my main portfolio, I would do exactly the same. Because the hardest thing right now is not the market, not whales, not manipulators, and certainly not Trump. The real fight is happening in your head, and the only one who will come out a winner is the one who can hold the position, stay calm, and not give in to panic. That's exactly what I do myself. I keep holding, don't sell, and reinvest all my short-term trading profits into spot, gradually continuing to buy the dip. I believe the market is falling, not because of some red catalysts, but because of uncertainty. And uncertainty is not the end of the cycle. It's a temporary pause that will end as soon as we see the first green catalyst. It could be one positive report, good news from the Fed, or the start of liquidity flowing into crypto. That's why I keep my positions and believe in my long-term strategy. What do you think about all this?